90% of the AI companies you see today will be gone in 3 years.
What if I told you the AI revolution is following the exact same blueprint as the $5 trillion Dotcom collapse? Right now, the air is thick with the same intoxicating "this time is different" energy that fueled the late 90s. But as a financial strategist, I don't look at energy. I look at the plumbing, and the plumbing is starting to leak.
To understand if we're in a bubble, we have to look at the infrastructure phase. In 1999, the hero was Cisco. They sold the routers and switches, the picks and shovels of the internet. Their stock went up 20-fold in 4 years. Today, the hero is NVIDIA. Their GPUs are the new routers. But here is where the story gets interesting. At its peak, Cisco was trading at a price-to-earnings ratio of nearly 470. NVIDIA, it's hovering between 30 and 50. On paper, the shovels of the AI era are actually significantly cheaper than the shovels of the dot-com era, but that's only half the story.
The real danger isn't the price of the chips, it's the revenue gap. Big tech, Microsoft, Amazon, Google, and Meta, is projected to spend over $320 billion on AI infrastructure in 2025 alone. They are building a massive digital city, but the citizens haven't moved in yet. A recent report from Bain & Company suggests that by 2030, companies will need to generate $2 trillion in AI-driven revenue just to pay for the computing power they're buying today. Currently, we are nearly $800 billion short of that goal.
We're entering what Gartner calls the Trough of Disillusionment. This is the part of the cycle where the hype dies, the tourists leave, and the real builders get to work. In 1987, Nobel laureate Robert Solow quipped that you could see the computer age everywhere except in the productivity statistics. We are seeing that Solow paradox again. While 71% of organizations are using AI, 95% of enterprise AI pilots are failing to show a measurable return on investment. The productivity boom isn't coming this quarter, or even next year. It takes time for businesses to rewrite their DNA.
So, is it a bubble? Yes, in the sense that the valuations of AI-adjacent companies with no real product are going to zero. But it's not a bubble in the sense that AI is a scam. The internet was real in 2000, but Pets.com wasn't. The difference this time is the balance sheets. In 1999, the market was led by unprofitable startups burning venture capital. Today, the leaders are the most profitable companies in human history. Microsoft and Meta aren't just betting their lunch money. They're using their massive cash flows to fund the future. They can afford to be wrong for a few years. You, however, cannot.
Here is your strategist's playbook for the coming correction. Rule number 1. Focus on cash flow, not AI washing. If a company adds .ai to its name but can't show you how it's saving customers time or money right now, walk away. Rule number 2. Diversify across the stack. Don't just own the chips, own the energy companies powering the data centers, the cloud providers hosting the models, and the software firms with sticky enterprise relationships. Rule number 3. Keep your dry powder. The dot-com crash was the best buying opportunity for Amazon and Microsoft in history. When the disillusionment hits and the stock prices of the winners get dragged down with the losers, that is when wealth is truly built.
The AI bubble will burst. The tourists will panic. The headlines will say AI was a fad. And that is exactly when the real revolution begins. Stay disciplined, watch the fundamentals, and remember, the market rewards the patient, not the loud. Follow for daily wealth-building wisdom.